Welcome to Concrete Conversations, the Indian real estate podcast. One of the biggest decision drivers for a real estate project is the financing. For developers, getting the right kind of financing is critical to ensuring that a project gets completed. Over the years, the sources of financing for Indian real estate have evolved from institutional banking to include NBFCs and institutional private equity players as well. However, over the last few years, we have seen a significant rise in the number of real estate focused alternative investment funds or AIFs, and this space is actually the fastest growing subsector of the Indian investment industry with a CAGR of over 50% over the last 5 years. To talk to us about the rise of AIFs and the options that the alternative investment space presents both for investors and for developers, we have with us today Mr. Ramashrya Yadav, the founder and CEO of Intergrow Asset Management. An industry veteran, Mr. Yadav started his career at Shapoorji & Co. before becoming the CEO of the real estate practice at Edelweiss Financial Services Limited. Mr. Yadav founded Intergrow in 2021 to contribute to the democratization of real estate ownership and the financialization of assets. So get ready to explore the rise of alternative assets in Indian real estate.
Mr. Yadav, thank you so much for taking the time to join us here on Concrete Conversations. How is your morning going so far?
Very good, very good. Thank you so much, and good morning to you both.
Good morning. And typically, we like to start our conversations off by getting to know our guests and their journey a little bit from where they began to how they got to where they are today. So, with that in mind, do you think you could give us and our listeners a bit of a career background for yourself in terms of how you came to where you are today?
So I started my career with Shapoorji in construction, then moved on to join a real estate company, end-to-end journey right from formation to taking it public
Right.
for about 12 years, and then joined Edelweiss to lead the real estate practice as CEO. Was there for about 7 years, and for past 3 years, I am involved in building Integrow as it is today. So a full circle in career, starting from construction to real estate to lending to real estate, and now investing and managing assets in real estate.
Right, absolutely. And just with that in mind, to give us a bit of a context to asset management in real estate, could you just tell us a little bit about what Intergrow does and where the asset management space fits in with the whole gamut of real estates?
So our vision at Integrow is to be the true fiduciary in India, but with a focus only in one single segment, which is real estate. Within real estate, our vision is to encompass every possible segment of asset, whether it is working capital, which is residential, commercial, whether it is owning income yielding assets such as commercial, retail, and hospitality, or even co-living and managed living, to even doing equity investments in real estate companies.
Right.
Right.
Perfect. Now that we kind of know what Intergrow does, I thought that we could kind of take a step back and look at this from an investor or kind of retail perspective as well. So over the last few years, we've seen a lot of new ways of indirectly investing in real estate for investors and retail investors. So, could you just take us through some of the different kind of options available for investors when for looking at indirect real estate investments in India today?
So yeah, I think one is what we are already involved in, which is alternatives investments. The second
Mhm.
is portfolio management. Third is REITs. And there is a fourth one which was there for some time, and I think it needs the rethinking in terms of regulations. Is the fractional ownership. So these are the four ways that investors can participate in real estate without actually owning the physical asset.
Right,
Right.
right,
Since you talked about alternatives, and we know that we're talking about AIFs specifically with Intergrow, that's the one of the prime categories that you operate in. Could you tell us a little bit about AIFs and then specifically category 2 AIFs and why they are becoming a preferred vehicle for promoters, for firms looking to bring real estate investment products to the market? What is different about category 2 AIFs specifically?
Yeah, so if you look at funding the real estate in uh, the format which was pre AIFs. It was largely the banks. Then, since 2012 and 13, it was NBFC led. And both these models of funding real estate are generally highly driven by asset liability management on a day to day basis.
Right.
And this is governed by RBI. Now, as the nature of the real estate is that the cash flows may not be very highly predictable, unlike any other industry,
Right.
because cycles within a year, and the sell cycles which kind of moves from low to high. There is one big advantage of alternatives is that alternatives monies are pooled monies from limited partners or the investors through a trust from where we invest the money. Now these are
Hmm.
not leveraged. This is not leveraged capital. So your
Right.
ability to manage the asset liability gap is much higher. And on the other hand, AIFs are governed and regulated by SEBI,
Okay.
Right.
and uh, these pools of money directly are pooled from individual investors above the multiple of 1 crore per investor or 1 crore per unit. That gives a huge leverage to the developers as well as to the fund to craft the solutions for the capital management for the funding of projects.
Okay. Okay.
And why category 2? Because category 2 allows the hybrid of equity as well as structured debt through NCDs,
Okay.
Okay.
versus category 1, which is only for equity, and 3, which is only for equity in social enterprises.
Right.
Right.
And just to specifically hone in on category twos and the difference between equity investment and debt investment, you talked about some of the benefits of equity, unlevered equity investment earlier on in your answer. I was just curious when you have is the benefit of a category two because it's equity and structured debt? Is it the benefit primarily just diversification of the investment? And how is this sort of managed and addressed from both the fund's perspective and the investor's perspective? Do the investors know which of the two categories, debt or equity, their money is going towards? Do they have a say in that, or is that something that the fund decides? And how do the investors predict what returns they're going to get on their money?
So, generally, by nature, these funds are pooled by upfront stating the objective of the fund and the structure of the fund. So, the
Right.
guardrails of transactions are pre decided. If there is
Right.
any change, the fund management or investment management will have to go back to the investors.
Hmm.
So, first point that we do not completely pull this money in a blind pool.
Okay.
The
Right.
opportunities, the characteristic of opportunities, the kind of instruments that we may use to invest are pre-decided. Now,
Understood.
as far as investors knowing uh, the the reporting mechanism is such that there are different classes of investment instruments used, whether it is OCD, which is optionally convertible debentures,
Hmm.
equity,
Hmm.
or NCDs,
Hmm.
non convertible debentures. These are generally the three kinds of instruments, and each of these are reported specifically with the investor individually, as well as the composite return at any given point of time is also disclosed to them.
Right.
Understood.
Right.
With this in mind, just a quick something to sort of lay the grassroots for understanding the fund structures a little better. Um, are the funds typically closed ended or are they open ended? And if they're closed ended, what is the typical time horizon for the fund?
So funds are typically closed-ended because they are invested in private, not so liquid opportunities.
Right.
Uh,
Right.
and the general formula is that from the day of first closure, you complete the final closure within the first 2 years, and
Hmm.
after that you complete the investment cycle in another about 1 to 1.5 years. So in a 3 to 3.5 year, you complete your investment on the strategy that you have pooled the monies, and after that you may decide to gradually exit or
Okay.
Hmm.
reinvest depending on the fund life cycle. Generally, the fund life cycle in India, most of the category 2 real estate funds are 5 years, extendable by 2 further years.
Understood.
Right.
Okay.
And just to kind of flip this and look at the other side of the transaction per se. So now that we know that this model of Cat 2 AIFs is getting quite popular with developers and investors as well, how do you think the kind of capital management and fundraising strategy for developers has changed now that there are these different types of fundraising vehicles available to them as well?
So, for past about 3.5, 4 years, largely the focus has shifted from NBFC funding to alternatives funding in real estate, and
Right.
more so as the evolution of real estate is happening. Generally, the NBFCs do not fund now the payments for premiums or anything related to the land till
Right.
the
Right.
development has reached some level of visibility in terms of construction as well as establishing the sales. So
Right.
it becomes more prudent that the developers raise the funds through alternatives, because after payment of premiums and completing your project by 10 to 15 or 20% in construction, the sales is such that it liquidates by itself. You may not really
Right.
need to go to even raise funding.
Right. Right.
Right. And, just following on from that, something that you mentioned earlier was the shift from kind of the NBFC space to the alternate space. So, with that in mind, I just wanted to ask you I know that, for us working in this industry, we know that from 2017 to now, it's like a whole cycle that Indian real estate has gone through. But if
Yeah.
for the benefit of our listeners, if you could just tell us about how this shift also represents the change of a cycle for Indian real estate from then to where we are now.
Yeah, I think, and I will stick to funding first. I mean, if you
Right.
look at typically how NBFCs uh, borrow and lend, they have to manage the cycle on both the ends. So, if you are
Right.
lending the money for a cycle of 2 to 4 years when self liquidating loans will be repaid to you, you
Hmm.
also
Hmm.
need to go back and borrow from your banks to match that similar kind of period. Now it
Right.
becomes
Right.
very very difficult for NBFCs to be so well on predicting that if they are borrowing a 5 year money and that 5 year money is going to go towards developers. So in a cycle, if there is any mismatch, their own rating will get a beating, and that's exactly what happened between 2017 to 2019 for a lot of
Right.
NBFCs, where the commercial papers, which were overnight papers, were invested in long-term real estate assets. And when the
Right.
demand to pull back that money came, that's where a lot of NBFCs faced that problem of liquidity, which now largely most of NBFCs have already solved.
Right.
But that's why their focus is more towards now predictable cash flows,
Hmm.
liquidating those loans so that their borrowing and their lending both is well managed.
Right.
Understood.
That's a big change that has happened.
Understood. Understood. One of the things that I think is a natural follow up to the conversation we're having is since we have this distinction of categories for AIFs, is there also a distinction in who the investor profile is across different types of AIFs? Or is it a similar investor profile, whether it's category one, category two, etc.?
So there is no restriction to what kind of investors should be there in different AIFs, but yes, there is generally, the income yielding funds, which buy income yielding commercial properties, have tendency to have the long term investors, including the institutional investors coming
Right.
as bank treasuries and insurance companies also, because it
Right.
forms part of their investment thesis. But working capital, alternatives, say for example, the residential, largely you would see that it is 80 to 90% money comes from the individual high net worth investors versus the commercial funds.
Right.
Right.
Understood. And this is a complete uh, in the moment question that's coming to mind since we're talking about different profiles of investors. One of the earliest episodes we had on this podcast was about how the market completely changed when foreign direct investment was brought into India. At that time was, I think, like early 90s or late 90s. And I'm just wondering, with AIFs and financial instruments coming out of the Indian real estate, do you feel that there will be an opportunity for foreign direct investment in fund structures like AIFs as well?
So there are already, close to about 27, $28 billion of FDI, which as of now, there is no mix between
Okay.
the foreign investors through feeders and the domestic investors. But that possibility always remains, and I think there is a huge Indian diaspora out of India which is very interested to invest in Indian alternatives and specifically in real estate. So I think that
Right.
opportunity
Right.
is large, and we saw that in fractional. We will see that even happening in the alternatives. It's just a
Right.
matter of time.
Right. That's
Right.
good to know.
Perfect. And since you mentioned fractional ownership again right now, and we had spoken about it as one of the new ways of indirect investment that have come up in Indian real estate. Um, since there is now this regulation coming from SEBI, I wanted to understand from you what the state of this fractional market is and what these SEBI regulations are and how they'll impact investors perhaps looking at this space.
I hope I'm not oversimplifying, but what has happened is that REITs generally become commercially viable if they are well above 4,000 to 5,000 crore, uh,
Right.
Okay.
and REITs work more effectively for pool of commercial properties, so the
Hmm.
risks are well diversified. Case in point for fractional ownership is nothing but micro and SME REIT, which may have
Right.
one or two properties at max. Number one.
Hmm.
Number
Right.
two, it may have properties which are not the entire buildings but floors or stacks
Right.
as a
Right.
portfolio. Now, when they are smaller, all you need to do is to have stronger sponsors.
Hmm.
They bring in their own skin in the game between 15, 20, 30%. Then it becomes much more palatable and the risk is well managed. I
Hmm.
think what the regulator is trying to do is uh, it is trying to completely cut those gray areas where a fractional operator is neither putting his skin to become an investment manager, nor is he becoming a completely a third party fiduciary or third party broker, right?
Okay.
So if
Right.
the regulation comes, it is nothing but REITs, a smaller version in form of micro SME REIT with some skin in the game, and I think this will open uh, opportunity galore for a lot of individual investors. However, one question still needs to be looked at it is that what would be the state of liquidity for those investors? That
Right.
is something that we are still to find ways and means. But India is a large market. All you need to do is possibly have 100 micro SME REITs, and that can have a different market altogether.
Right.
Right.
Perfect. And just one sort of follow up on that. So I know that this is still in the consultation phase. There's back and forth right now between SEBI and some of the operators. So do you think that the basic tenets of having skin in the game and everything for these operators, do you think that's going to stay and it's just a question of numbers and margins right now?
I think the bigger question is that most of the schemes that you see are basically pooled investments.
Right.
from different investors, which does not follow either the guidelines of company law board of not doing public equity or public issuances beyond 200 investors,
Right.
or
Mm.
on the other side following the SEBI's alternatives rules where you have to take minimum 1 crore from a qualified investor. So these are
Mm.
the two areas which I think the regulation is trying to stitch together.
Right. Right.
Right. Just to take a step back, and look at the larger picture here. If we look at Indian real estate now from what 2016, 17 to now, from the introduction of REITs to the introduction of fractional and now the regulation of fractional, the growth of AIFs, this trend of securitization and kind of capitalization, formalization of grade A real estate has come a long way in the last few years. So I just wanted to get your opinion on this trend. Where do you see this going? Do you see it becoming more inclusive in terms of investor profile or asset class, or the kind of offerings available? What do you see as the future of this securitized real estate space?
I think we missed one more elephant in the room, which kind of has become, um, I would say, the transformative journey of real estate started from introduction of RERA.
Right.
Right.
And
Right.
then of course the demonetization. These are two very large factors, coupled with GST, which is
Hmm.
the epitome of formalization of this industry, I would say. So
Hmm.
the
Hmm.
trio of demonetization, RERA and GST is giving massive headway in terms of digitized records in real estate, and I think that's going to change and democratize the participation from investors across.
Right.
And if you see the growth of alternatives that has happened in last about 5 years, the large part of that can be attributed to the comfort and the convenience of believing on the data that is coming. And I think it is just the
Hmm.
start. As more and more
Okay.
data comes, more and more predictability happens. I think today in India, there are close to about 8 to 10 lakh qualified investors. And when I say
Hmm.
qualified investors in terms of AIF, you need to have 5 crore or above investable surplus as defined by
Hmm.
SEBI for a qualified
Hmm.
investor. I think it's 8 to 10 lakh, and that's easily going to go to about 30 lakh. So
Wow.
there is
Hmm.
a huge amount of wealth and saving that will come to the AIFs in and specifically in category two, because that's where the opportunity to structure the deals is much better than others. So I think this is just the start for real estate.
Right. Right. I wanted to touch upon something from the investor's perspective specifically, and give you a chance to maybe pitch the concept of alternatives to an investor through the lens of this podcast. How would you say a typical credited or typical high net worth investor or institutional investor should consider an AIF or as a means to investment in real estate? What is the recommended lens you say they should have before investing?
Yeah. So I think there are three or four criterias. And the first criteria is when you choose the investment manager, how do you really see that they are managing the conflict?
Specifically, could you elaborate on the conflict that you're referring to?
Alternatives business is fiduciary in nature.
Right.
If
Hmm.
you have a advisory business, if you have three other businesses, or let's say you already have a real estate business to do alternative business, there is a conflict.
Right.
Now, how do
Right.
you create the Chinese wall between different businesses and
Yes.
still, work for the benefit of your investors is what we call as the conflict management.
Right. Right.
I
Right.
think the second is that how do you really do the compensation management? What is the skin of the team which is managing uh, your investment? It's not
Okay.
just brand, it's not just one person. But why do you think the investment management team will stay for the entire tenure of the fund? It's a good five to
Right.
7 years. How have you
Mhm.
structured that is also very, very important. I think the
Right.
third thing is that what kind of strategic choices or trade offs the fund has made, where will it not go and invest, is sometimes becomes more important than where will it invest. And
Mhm.
I think if those choices are made clear, then the last one comes is that what is the model of conversation or engagement with the investor is followed. Is it a
Mhm.
monthly dashboard? Is it a quarterly dashboard? Is there that whenever you are onboarding a deal, do you really engage or involve in some ways, or at least do that once in a quarter? I think those are the things which become very, very important. And the
Right.
reason I'm saying that is that historically and globally, most of the fund managements or investment managers bank upon the legacy.
Right.
But
Right.
my belief and very strong belief is the legacy can either prove to be, an enabler, or it can also prove to be a liability. I
Mhm.
think
Right.
maintaining that balance in terms of how the fund manager or investment manager is backed by technology processes also becomes very, very important. Because, and the reason I'm saying that is, in India, alternatives came in existence in 2012. The growth
Hmm.
Mhm.
started happening somewhere in 2017, so we are only 5 year old, conceptually, if you see, and we are
Right.
just crossing now 10 lakh crore and above. So it will become the size of mutual funds in next 2 to 3 years, that mutual funds are today.
Right,
Wow.
right. No, I was saying that's impressive. And
Yeah.
I think another follow up, and I know you touched on this, I think, earlier on in the conversation, but I thought we could spotlight it a little bit and talk about the asset classes that alternatives typically invest in today in real estate in India, and then maybe where you see them in terms of asset classes expanding to within real estate in India.
So largely, if you see the journey as of now, you will find that 90% of these investments have happened in the residential, because um, most of the investors' current need had been more around yield plus some compounding.
Right.
Right,
Right.
And they like the self liquidating kind of
Mhm.
assets, right? Because
Right.
for other side there is REIT and there are institutional and investors. But for past 2 years, we are seeing that there is a new class of investments that's starting to happen in area of commercial office spaces. And I would not be surprised that there are new forms of investments which will happen in managed living, whether it is student housing, senior living, STEM housing, going up to even healthcare and retail.
right.
So I think that's just the start, and most of these different classes of investments will emerge in next 2 to 5 years.
Understood.
Right. And just to touch upon something that you mentioned there, so do you see this as two parallel segments growing? There's the kind of institutional grade investors who are looking at long term stable cash flow versus, like you said, self liquidating or investments that have a defined kind of end or a defined sale at the end of it. Do you see these both growing in parallel?
I think this both will go in parallel, and if you really look at the alternative space per se, in India, largely in the first phase of investing, we saw direct equities.
Right.
Then came the mutual fund Sahi Hai era, where mutual funds have
Right.
grown because then managed investing came and took the center stage. And I think the third stage, where India has just entered in last 2 to 3 years, is the alternatives, which is basically nothing but the private opportunities beyond the listed spaces.
Right.
It
Right,
is just the tip of the iceberg. So alternatives, whenever we talk about alternatives, I think we are talking about private opportunities beyond the listed space. And
right.
Right.
generally in most of economies, the ratio is somewhere between 30 to 70.
Hmm.
We are
Okay.
right now not even possibly 2 or 3% of private opportunities to listed opportunities. So that's the kind of highway that we have for growth.
Right.
Right.
And I think you've touched upon something that I wanted to ask anyway, which was, we've seen these cycles now of a wave of foreign direct investment coming, a wave of public, domestic real estate investment coming through REITs and stuff. Now we have the private options as well. So do you see this as the next sort of capitalization wave in real estate, that alternates can be a driving force for domestic investment and participation in Indian real estate?
I think I have no doubt about it. And as I said, that the entire movement that is happening from the large banks, the housing finance companies at a national level, and now there are massive wave of growth in the regional housing and finance companies. So I think what will happen, in my view, is the NBFCs, housing finance companies, and the banks will uh, go around on the retail loan portfolio, and that's the kind of growth you are seeing across. And when it comes to the saving getting into the formal investing, it will happen through in equities, mutual fund, and PMS to some extent. And
Hmm.
in alternative space, it will happen through AIFs.
Understood.
Right.
Understood. When we talk about the securitization of real estate, I think the one of the big markets that the world around has taken lessons from is the U.S. market. Um, we've already seen India's real estate market dev- have a different trend or deviate slightly from the trend of the US market, especially with when we talk about commercial real estate, which is struggling in the USA right now. But in India, the work from home culture is not as alive as it is in the States. Many companies and many employees, in fact, are very keen to go to the back to office culture. They enjoy that in person, interaction, and they enjoy, having that break from home to go to office and work from the office space. I think it's a little more traditional in that sense. Uh, when we talk about securitization of real estate, do you feel that India will move in that same direction as the US market had moved when it first started out with securitization of real estate, or do you think there are some unique differences that will always keep the Indian real estate securities market distinct from that of the US?
So let me put it in two ways. I think where we are in similar territory of growth in terms of comparing the US real estate and India real estate is possibly where they were in 1990 to 95, we are today.
Hmm.
Right,
Our overall commercial supply of grade A office spaces is possibly only 10% of what we need, right?
right,
Um, to draw a parallel from US to India's growth story, I think there may be certain differences, and those differences are driven by certain cultural changes which may happen because of we being digitally very, very advanced. So
okay.
I don't think, and I don't subscribe to the fact that our growth will be true copy of how it
Hmm.
happened in US, because our geographical expansion may happen in tier two, tier three cities also.
Right.
While we talked about smart cities and such concepts. Maybe that next wave of real estate growth happens through the smart cities. It will certainly be different. It will not be the same that happened in US. While our size may be much much bigger, given our size of population, it may be completely different. But
Right.
the format would certainly be different, in my view.
Right.
Understood.
Perfect. Since you mentioned smart cities, I just had a short follow up. I thought I could ask you. It's that it seems like we're at the start of, or in the starting stages of, a kind of new growth cycle in Indian real estate right now. So, like, since you mentioned smart cities and stuff like that, are there any developments that you are excited about over the next few years in this sector, whether it's infrastructure or regulation or whatever it might be, that you think will help propel this industry to the next level?
So, in my view, I think smart cities was talked about a lot, but then there is no noise that you hear in last 3 to 4 years. But I
Hmm.
must tell you the kind of infrastructural work that is happening, and if you look at the crane index, India is almost consuming one fourth and little more of cranes for constructing the infrastructure currently in the country. So you will see the growth in smart cities possibly from 3 to 4 years here on. I think we talked
Right.
about little early, but we will be catching up very well. There are 100 smart cities, and in 22, I was lucky to visit close to about 35 of them.
Wow. Wow.
And I can roughly say that in about 10, there was advanced level of awareness and work and planning happening. In about 15, it was not so much, and in about 10, they were quite behind. Uh, but in my view, the concept of smart city is walk to work. And when you talk about walk to work, it's also what economy does drive the work there is very, very
Right.
important. And I think next 4 to 5 years in India, this will be different economic centers driven
Right.
by different demand and supply, which will
Hmm.
give the growth to the smart cities. So I'm very excited about the smart city development.
Perfect. And I think that brings us to the end of the questions that we had for you today, Mr. Yadav. I just wanted to say thank you, a big thank you from both Akshay and I for taking the time out to be here today and for giving us and our listeners some more clarity about the alternative space and the indirect investment options for Indian real estate.
Yes. Thank you so much for your time, Mr. Yadav.
Thank you.
Thank you for listening to Concrete Conversations, the Indian Real Estate Podcast.
We're excited to announce that we're now in video format on YouTube.
For highlights from our episodes, check us out on Instagram.
And as always, stay tuned for more concrete conversations.